Yesterday's buy signal fired off, and you can see that the market rocketed off of that, and the levels that we were looking for have been now confirmed. But I guess the question is, what next? So we're going to get into it today. You can see across the board over here, especially on the altcoins, it's been a completely green day. On the hourly, slight pullbacks. You can see on Crypto Bubble, some of the coins are pulling back, but it's quite interesting when you consider that yesterday's CPI year-on-year data came in worse than expected. So the forecast was at 6.2% and the actual was 6.4%. So coming in a little bit hot, and the risk on assets pretty much called the bluff and continued to rally on up. So what to expect next, because there is going to be another FOMC meeting that's coming up soon. I think it's on the 22nd of February. You probably want to mark that off on your calendar. And let's start off over here with Ted Talks Macro. So he shows here that the headline CPI was up by 0.5%. And then you had that expected month on month was pretty much on exactly where it should be. And he said bears are licking their lips at a reacceleration in core inflation. So basically showing that the core inflation is increasing, and therefore maybe the interest rate hikes are probably going to continue for longer than we expected. So is it going to be higher for longer? That is the big question. And he said it's very hard to ignore that the markets are repricing since the recent NFP, so the non-farm payroll print, particularly on the front end. And he shows here equities and risk in general have been very stubborn thus far, but he's finding it hard to see that continuing. And the reason why is central banks are data dependent, so we must be nimble as traders. And you can see if you have a look over here, again, massive run up in the after the non-farm payroll. Markets continued on up, and he's saying that they're very data dependent. So he's monitoring this over here. If you look over here, you got the US 2-year treasury yield, which is pretty much coming down, and stocks continue to go up. Bitcoin continues to go up. So will there be a turning point? And I'm finding a lot of conflicting at least opinions when it comes to what's going on in the markets. I want to give you both the bullish and the bearish case today. So stay tuned until the very end, because it's a high time frame. It's very important to look at all of these facts. According to Benjamin Cowan over here, he's showing that the market now thinks that there's going to be 3 more 25 basis point rate hikes, and that will bring a terminal rate of 5.5% by June. So followed by holding it there until December. And then he's saying at that point, the market then thinks that the Fed is going to end up cutting the rates completely, which you can call a pause or pivot, whatever it is that you want to call it, but basically signaling the end of the rate hike. So that is at least what the market thinks. Now, from a bearish perspective, this is quite a long thread. I'm not going to go through the whole thread, but it's from Game of Trades, which has been a pretty solid account, great research. And they're basically saying that the stock market is now showing extreme signs of greed. It's only the 6th time that it's happened in history. 5 out of 6 signals mark significant market tops. So it's got quite a high hit rate when you look at it from a sentiment perspective. The S&P 500 is broken above its macro downtrend line and 40-week moving average. That's also known as the 200-day moving average. And investor sentiment is flipping as people are jumping on the disinflation and Fed pivot bandwagon. But based on the information that we received yesterday, maybe inflation is not as under control as we had hoped, because the reading came in a little bit hotter. But that could also be because they've reworked the way that they get to that ultimate figure. They've changed the structure on how they work it out. And he says under the hood, the fundamentals don't align with the renewed optimism. This chart shows that the spread between the yield and junk bonds and cash. And he says that the difference is now at the lowest level since it was in 1979. And if we have a look over here, investors are asking for the same yield on high risk BBB rated corporate bonds as that on a 90-day treasury bill. Current macro environment gives a high incentive to hold cash yielding over 4%. Higher risk investments like corporate bonds are mispriced. And he says with a decade of unprecedented monetary easing, risk seeking has been the trend since 2008. Even though the Fed keeps its higher for longer tone, investors have doubled down. So investors are calling the bluff on the Fed. They basically are not buying it. They think that the market should be going up, and the market is dictating where price should go, and therefore the market participants are buying everything up. And we can see what's happening in the stock market, a massive relief rally that's in certain stock markets is turning into a full-blown bull run, and I'll show you those ones in a moment when we get to the next tab. So he says this chart marks the 5 previous instances when we saw greed like we have today. You got basically 2007, 1979, 1973, 66, and 1929. Basically, all just before a major market sell-off. So 5 out of the 6 signals marked significant market tops. The exception being in 1979, where the market ended up being flat for 3 years. So have a look at that chart. Basically, the greed levels that we're experiencing are marked by the vertical lines over here. We're in the exact kind of zone that you're seeing over there. And I think I'm going to leave it at that. You're welcome to go through and read through this whole thread. But essentially, he's saying that fundamentally, it doesn't really match where prices are at the moment. Prices should be lower, at least on the stock market. And Jesse Olsen over here says, just another crazy idea of the S&P 500. You guys all know that Wall Street cheat sheet, which goes through the different phases, psychological phases. The worst being when you have the complacency bounce, everybody gets bull chat, and we know where you go after that, right? So you have euphoria, you come down, complacency bounce, everybody says it's fine, the stock market just had a cool off, or any market for that matter, just needed to cool off, and we kind of need to reaccumulate, form a strong base, and then it's going to be up only from there. But then complacency happens, and you go into anxiety, denial, panic, capitulation. And he's saying that we haven't yet seen that. I'm going to bring up my charts now and show you what I'm seeing, which I find incredibly interesting. So Dow Jones, there's the line chart of the Dow Jones. Could it be a complacency bounce? 100% it could. It definitely could be a complacency bounce. NASDAQ, yes, it could be a complacency bounce. This is on a very high time frame, which is the monthly chart. The question that I want to pose is this. From Jason over here, he shows that new all-time high price for the UK stock market, the FTSE 100, January 2023 was the highest monthly close in history. And that's the question, right? Do you see highest closes ever, pretty much stock markets closing at their highest levels ever when you're going into a recession? If it's a complacency bounce, that shouldn't happen, right? You shouldn't be seeing things like that. That is what you see in bull markets. And he says the double top possibility is there, but if there is no correction below the second yellow line, then basically this will be a massive upside move. Experienced traders will know the saying, a failed signal is a signal within itself. And another new all-time high for the FTSE 100, which is the UK stock market. Has there ever been a recession confirmed while stock market is at all-time high prices? And he's basically just posing the question. So yes, if you start to drop below that line over there, it is a possibility it's a double top and you're coming back down into the range. That would be incredibly bearish. But how long will it be before the US stock market catches up to these other stock markets like the UK stock market? When I looked yesterday, the S&P 500 was only 15% away from making a new all-time high. So it's definitely a contrary opinion. And in trading, it's good to be a contrarian, but this is a big but. You have to be a contrarian at the right timing, at the key pivotal points where you have stop and reversal levels, where the psychology and the emotions are very high. That's when it's good to start to think about things from another perspective. And I always consider both the bullish and the bearish case. So here we have it. This is the line chart over here. And pretty much Jesse Olsen is calling this section over here the complacency bounce and looking for extremely low prices. But when you zoom in, pretty much stands out like a sore thumb to me. This is also another possibility. And this is why I say I like to look at things from both the bullish and the bearish case. I don't know if any of you can see it over there, but let's just pull that line across, make it nice and big. Does that not look to you like it could also potentially be an inverse head and shoulders pattern on a monthly chart? If so, then of course this is going to have a measured move much higher, pretty much nearing those all-time highs. And even if you're treating it as a short time frame trade, that's okay. You don't need to become an investor that's going to lock away your positions for the next 10 to 20 years, saying that we're going to continue rallying up to 6, 7, 8,000 on the S&P 500. You can still treat this as a relief rally, and Jesse Olsen could still be right. You could get to these 4,000, 4,500 levels and still make a lower high on the macro, on the monthly time frame, and have a complacency bounce and then go lower. But historically, you're probably better off being a bull in the stock market. So that's one thing that I'm looking at. The other thing, I don't know if you saw, I can't even pull up the tweets because everybody that tweeted this has now deleted it. This happened in a couple of hours ago, probably about 6-7 hours ago. They essentially said that Circle, which issues USDC, the stablecoin, has received a cease and desist to basically stop. And pretty much here you have from the chief strategy officer, he came out officially and said Circle has not received a Wells notice. And if you go over here, a lot of FUD about USDC right now, but keep this in mind. So even if these rumors start to resurface, do keep this in mind. Big players, huge players within traditional markets are involved with USDC. So you have BNY Mellon is their custodian. BlackRock, we all know how massive BlackRock is. They manage their reserves. Visa settles transactions in USDC. It's 100% backed by cash and treasuries, and it's audited by Deloitte. Annual audits filed with the SEC. And then he said he thinks that the FUD is overblown. So if it comes down to any stablecoin, firstly, like anything, you can diversify your risk amongst various different stablecoins. There's RAI, DAI, Tether, USDC. There's a whole list of them. You can go and research and find out the list of them. I kind of split mine, but personally, I feel most comfortable with USDC just because of the backing of these major organizations. Not that I'm in agreement with them ethically, and not that I love BlackRock, but BlackRock is enormous. If they're involved, probably not going to fall. No such thing as too big to fail, though. But I just think that if these rumors do come out again and they start to become true that the SEC is going after them, it will probably go to court. It's going to take many years. And by the time you have an end result of basically what's going to happen with these stable coins, or maybe they have a CBDC, at that point you already have tens of thousands of different competitors that have hopefully come out, and you can start to move into those. So I don't think that's reason to be concerned. I've been receiving a lot of messages from friends about that. All right. In light of the uncertainty within the markets, especially the stock markets going up to new all-time highs or being in a complacency bounce and going down to new lows, I think sometimes it's best to just keep it simple. And I'm sure that you can all agree, if you have a look back on previous market cycles. Let's take a look over here. Let's take a squiz at this section. I'm sure that you can all agree that had you had the opportunity to dollar cost average in that lower half, you probably would have done very well. Had you had the opportunity to dollar cost average out in the top half, you probably also would have done very well. So I think that right now, this is definitely a year for dollar cost averaging. And I was never someone that told anybody to dollar cost average in the top half over here. But because it's getting increasingly difficult to trade these markets, it's a tough market. I can promise you that a lot of the top funds are struggling to manage their risk and control their positions within this market. As a retail trader, yesterday I told you have a superpower in that you can decide when to enter and exit the market, and you don't always have to be invested. So dollar cost averaging is one powerful strategy, and I just want to re-emphasize it using this chart. If you look historically, and I'm not going to go back all the way into the history, but in a nutshell, round about 1 year before the halving event, the halving happens every 4 years. 1 year before that halving event, I've marked off with this orange line over here, is typically where you start to see major reaccumulation in the crypto markets take place. You can use Bitcoin as the proxy, the main litmus test that you're looking at. And then you can still scale into altcoin positions if you do want to take on more risk, because of course, a rising tide lifts all ships. So if Bitcoin goes up, it's going to lift all ships, right? For the most part. So I still suggest that you guys consider dollar cost averaging over here, because let's say, for example, those ultimate bearish targets are never met. I did outline to you guys a long time ago already. I said we're looking for the potential of a complacency bounce that can take, or a relief rally at least. See, I've got complacency in my mind. A relief rally that can take prices up to anywhere between 28 and 32K. And you could still come all the way down to those lower levels at a later stage. Now, you can never be too sure. You never know if you're going to hit these levels or if this is the bottom and price is just going to reaccumulate out of here and go into a new bull run. So therefore, one strategy to use is 100% going to be that dollar cost average strategy. And what you typically want to do is from about 18 months out, you want to start to dollar cost average, which would have been around here. And that would make sure that irrespective of what price action does over here, for the most part, so let's say price action does this. For the most part, this is going to be your entry, your gradual entry into the market. Now, going back to 2017, what would that look like? Here we have 2017. So had you stuck to that dollar cost average plan, you probably would have bought your Bitcoin at an average price of, I want to say, probably around this $5,000 mark, between $5,000 and $6,000, which you would have done exceptionally well with over time. So consider using that as a strategy around the timing effect. And then the same is true when the market obviously goes into a top. Let's just quickly go back. When the market starts to top out, it typically happens between 52 and 80 weeks after the halving has happened. So that's your potential timing zone using the mining, basically using the halving and the mining rewards as your indicator of when to possibly time the market. So the same is true. Your dollar cost averaging will happen over a longer period of time, right? You want a dollar cost average over a longer period of time because the market tends to accumulate for longer than what it rallies up and starts to distribute. The distribution phase is a lot quicker. I'm sure you can all see that there, right? Look, extremely aggressive up phase, distribution came back down. We had a double top scenario over here due to over leveraged players in the market, and then distribution and came straight back down. And then over here, you're in that accumulation phase. It takes a very, very long time to go through that accumulation phase before you start to rally. So therefore, you want to distribute your dollar cost average positions that you made down here when you get into this zone higher up between 52 and 80 weeks post halving. If the timing indicator is accurate, that's going to be between about May of 2025 and November of 2025. Some of you are probably not going to remember the show by then. So I don't know, make a mental note, set a Google Calendar or something. You're probably still going to have a Gmail account by then. Set a Gmail account to say, remember Kyle's video, take the video, put the video into the Google Calendar event over there, and then remind yourself this is when you want to start dollar cost averaging out of those positions a lot more aggressively. So I have my dollar cost average portfolio set up over here. I am using OKX. It's very, very simple. You probably have this on multiple different exchanges. So not to say that you have to use OKX, but if you do wish to, there is a link in the description below which gets you access to sign up bonuses if you use my affiliate link below. So feel free to do that. What you want to do is go from manual trading to trading bot. You then will see a whole series of different options over here under the trading bots. You can choose multiple of them, but the one that I'm using is called the recurring buy. So you click on recurring buy, and over here, you'll be able to build a portfolio. You can create one bot that holds anywhere between 1 and 20 different coins. You can change the allocation split if you want to give this one 25%, this one 15%. For example, you can switch those all around. Let's change that again. 25, 15, etc., etc. You create the bot. You select the time that you want it to allocate. So do you want to buy monthly? If so, which day of the month? Do you want to buy weekly? Which day of the week? Or do you want to buy daily? I'm currently running a daily bot because I just think it's maximum opportunity right now. And I don't want to set it on a weekly in case there is some sort of a major flash crash that I'm not saying it's going to happen, but hypothetically, Bitcoin goes down to 10K and my bot didn't buy on that day, and immediately you V-shape recover, and I'm only buying on a Wednesday, and the crash happened on a Monday, and that's it, I've missed out. So I've set mine on a daily time frame. There is basically, okay, that's a P&L, not important for right now. This is a long-term play. It's a $50,000 account. I'll monitor it with you guys throughout. So every couple of weeks, I'll bring it up. But there you can see it. It just basically, in a disciplined fashion, continues to buy day in and day out. It's allocated towards the coins that I've chosen. I've given you the coins before. Feel free to screenshot them. Pretty much there they are. All right. So that is OKX. For the stock market, though, what is going on in the stock market? Yesterday, I put in the daily candle newsletter that as long as this area holds as the next higher low, which so far from a candle anatomy perspective, it's looking similar to this candle. It's holding very nicely. If this can hold as a high low and price can consolidate for a little bit longer, my next target would be all the way up at the range high, which is going to be at 43.30. If you don't have experience trading the stock market, the S&P 500, but you want exposure to other asset classes, I gained my exposure through this guy, king of price action. Don't all go follow him at once. He's going to be swamped with equity. There are other guys that are pretty good, but I'm using a copy trading strategy over here. I see he's up 9.22% today. So that is also in the description below if you do wish to seek that. Next, Total 3 is in a very, very important point. Yesterday, I told you guys that, okay, we had the double top scenario, price sold off. Now you want to see a reclaim of this level. You ultimately want to see prices get, or at least this index on Total 3, to get back above this area, which is 370 billion. You cleared the first critical zone, which is the dotted line, but it needs to get up and hold above this level to be convincing as pretty much flipping that area from previous resistance into support. So you can see resistance over there. We've broken the trend line. You don't want to see it act as resistance once again. Otherwise, it is probably going to come down to the range low. So altcoins, yes, they're bouncing harder, but they also sold off harder. And they constantly remain a lot more risky than what playing Bitcoin would be right now. Bitcoin is a lot more clear, and I'll go through the levels on Bitcoin for you shortly. You know that we've been looking at different back-tested results on the 50 and 200 EMA, or MA at least, as well as the super guppy indicator, which is the title of this show over here, pretty much looking at 170% potential return if it plays out the way that it did in the previous cycles. So I wanted to look at this chart from Kyledoops. He basically charted over here. He said, this is your last reminder that every single time BTC has broken out of a major high time frame bearish resistance versus the NDX, then it's had a face melting rally, which follows suit. And he says, I have a hard time believing that this time is going to be any different. So there you have it, measured against the NDX. Big breakout over here leads to a massive, massive rally. And will this time be any different? Well, in line with what I'm looking at, it shouldn't be. So prices come into the 200 EMA. You have a wick that went directly into that area. And this is looking good as a potential for another higher low. This is what we've been on the whole time. We've been talking about being on higher low watch. We're looking for the higher low, for the opportunity for prices to come back and clear the key monthly. Once you clear this key monthly level, 23,954, a big short squeeze will commence, because pretty much no more shorts can hold their positions. Once you, I think most shorts, you have to always ask yourself, the people that shorted early, where have they placed their stop losses? The people that longed early, where have they placed their stop losses? And I think, very simply put, the guys that started shorting over here, so around this level, I know Trader SC was one of them. They'll have their stops probably placed around this region over here. So if price comes up, and it rejects from here, yes, then you need to watch again that this zone is going to hold. If this zone doesn't hold, then it's going lower. That's going to be bearish confirmation. It's a bearish retest, and you can confirm that prices are probably going to go low. But if you can clear above that level, a short squeeze should commence, and I think that will get you above the key monthly, and then you can look at higher prices. You'll notice on my chart, I've marked off this vertical line. That is for the 22nd of February, which is going to be the FOMC meeting, or it's minutes at least. FOMC minutes, they're definitely going to comment on the state of the market, and it could be a market-driving event where you kind of want to tighten up your positions going into that. But from a high time frame perspective, Bitcoin is looking pretty decent in the sense that it is holding these levels. It's holding above that zone. I did want to see a dip further. I really wanted to see the 0.382 tag, the shallow fib. But it doesn't always have to work like that, right? You can have, if the market is more bullish, it can front run that. The next, I told you, if Bitcoin can hold those levels for about 24 hours more, which now those 24 hours have passed, then it increases the bullish confirmation that it's probably going to be a high low and continue on up. So the same, I'm going to say the same thing. That probability is even higher now if Bitcoin can hold around these levels. You can now raise your invalidation pretty much to that 200 EMA, which is where that wick is that we have. The super guppy indicator also has wicked into an important zone. So you can see how this, if you go back test, this moving average is pretty much governed the higher lows throughout. And as long as it can hold above this level, I don't see any reason to close the long positions on Bitcoin. Stops, though, will be placed below this wick. I think I have it on this chart for you. Here you go. 20,358 is where most of the people that went long at $16,000, they've all raised their stops. Those stops are going to be over here. If you do see price come back down to this level, it should be quick and a quick reaction out of that zone. So let's go on to the lower time frames to see how the bearish case could potentially play out if there is going to be a bearish scenario. First level was cleared. That's the 22,091. We got the closes above there. I told you if you close above there, then you have increasing odds that you're going to break above this trend line. But now you need to wait to see, is it actually going to do that? On the 4-hour chart, you do have momentum oscillators, which are starting to roll over. So if they do roll over, all that I want to see is I just want to see that price manages to, again, hold above the 200 EMA on the 4-hour chart. I'll look at that as the next opportunity where it can basically break through, and then that's your final confirmation. Once you break through this trend line and you can hold above this zone at 22,000, let's round it up for the sake of conservativeness, 23,350. If you can hold above $23,350, which is, that is a terrible line, just 1 second, which is this zone over here. Perfect, the green line. If you can start to close multiple 4-hour candles above that zone, then I think this will look right for another big move up. Daily chart, using the momentum oscillators, have a look at that. These have reset and they're only just starting to curl up now. I told you guys, watch, they might move around here a little bit when they get into this bullish zone, so above the 20 mark. That's your final confirmation. That likely happens at the exact same time that you get above that 20,350 level. Here you go, the green line. All right, there we go. So next, on this time frame over here, pretty much same thing. This is just using the stochastic RSI. You can see it is turning down. Volatility has picked up. On the low time frame, you can see that, on the daily time frame, you can see that, again, it's just turning up and the volatility is cooling off again. It's starting to contract. So what will be great to see is if you can see price holding those levels, slowly grinding sideways whilst this volatility indicator starts to crawl back down and then get back to low levels, signaling that there's a compression ready, like a spring, right? Like a spring compresses, ready for the next major expansive phase to the upside. So that's what I'm watching over there, guys. Please take a look in the description below for those links. Give the video a like, hit the bell notification, and subscribe to the channel. With regards to the Rolex, if you watched Rand's show yesterday, let's just quickly make that big. Help me out, James. There we go. If you take a look at this Rolex, it's see-through. Look at this. This camera is bugging out here. That is crazy. Anyway, there it is. Maybe I'll put it closer to me. I think this one was given away yesterday, but I just checked with the office and apparently the person hasn't claimed it yet. Therefore, this one is still up for grabs. All you need to do is in the description below, sign up to Bitget for this one. Click the link over there, make a small deposit and take a trade. It can be as low as $1, $2. It doesn't matter what you deposit. Make a small deposit, take a trade. That's an entry into the competition. The other one that we have is the Submariner Blue and Gold. I think this will be the last one that Rand will give away because it's the most rare. That one is with ByBit. Same thing. Click the link in the description below. Sign up, make a small deposit, and take a small trade. The more trades you take, the higher chances of winning. And that's it from me, folks. I will see you all on the next video. Please give this video a like, hit the bell notification, and subscribe. And best of luck with your trading. I'll be as active as I can on Discord and on Twitter today because I know we're at a pivotal point in the market and I don't want you to miss out on the next move. See you all later. Cheers for now.